You ready? Just tell me when. 3, 2, 1.
We're live.
Hey, welcome everybody. Thank you for joining us for part 2 of Navigate 2020, a new webinar series that we've created to try to bring you some value and some insight as we manage through the COVID coup. We talked about the COVID coup last time. We really like that phrase because coup obviously is a takeover, and COVID has taken over quite a lot from everybody in our personal lives and our professional lives. And we also like to play on the word COUP because everyone is cooped up. You can see I'm coming to you live from the home office, which is a new thing, the WFH, which we now have an acronym for, work from home. Everybody's getting used to this new program professionally, personally, schooling for our children, etc. It has been quite a time. We're very hopeful that today is valuable for you. We're going to make it very interactive. We're going to try to make it fun. I want to remind everybody that we try to stay positive during these tough times. The crises that we've faced in our country have been very difficult over the years. We've been up and down and sideways and so forth. And somehow, some way, we've always figured a way to get through. I thought about it last night quite a bit about how important it is to remember to be thankful in a situation like this. Thankful that we're in a great country like America. My wife gave me the idea to throw this giant onesie on. We had it made at a tent factory here locally so I could get it around myself. But to remind ourselves that we are very fortunate and hopefully remain thankful and thoughtful as we're moving through these tough times. And it's nice to see that we are making some progress, maybe more progress in certain areas of the country than others. But since the last webinar, I think progress is being made. And I do see folks having a little bit better outlook. There's still plenty of anxiety, plenty of fear. Please try to focus on being thankful and thoughtful and being focused and being ready. And hopefully today you really enjoy this. Really thank you guys for joining us. I know there's a lot of stuff out there. We're trying to make this different for you and just really bring you some value. So without further ado, we will get started. Bear with us on the technology pieces today. Hopefully by now you're seeing the screen of the presentation. We only have 400 slides. This is only going to take about 3 hours. Last time it went pretty smoothly, so we'll get started. In all honesty, it should only take 1 hour, and we are going to have a Q&A session at the end inside that hour. So let me do a quick intro to our guys and welcome them in. I really appreciate these guys, thought leaders in our community here in North Florida that have stepped up, put a lot of time into this. These things are not easy to pull off. We've got Jack Caven today from InfoTech. He's going to handle our technology piece. We've got Pat McManamon from Sandler Sales, who's going to be talking to us about sales and management. And we've got Alex Jenkins, VP of NestEggs, who's going to be talking about God knows what, but we're looking forward to having him on as well. Couple of ground rules for everybody out there. I mentioned interactive. That's a big deal. Last time we did this, we had some polling questions, and then again, a big Q&A session at the end. We went a little long with the Q&A. Please populate your questions at the bottom of the screen with the Q&A button. The polling questions are just going to appear throughout the presentation. Please respond to those. And if you do it pretty quickly, the thing goes away as soon as you respond. So if you could do that, that'd be great. We'll share those results with you as we move through. And without further ado, I want to kick off with our first speaker, Jack Caven. This is a little more formal introduction of Jack. Jack is a rare breed, a combination of a technologist, maybe you might want to call him mad scientist. He is a very strong businessman, and on top of all that, he's an attorney. So triple threat. Jack, I'm going to turn the wheel over to you, and hopefully you won't drive us into an iceberg or something.
Thanks, Jim. And I want to thank the attendees here today. And for those listening in the future, I want to remind you that this is being recorded during a quarantined world as a result of the COVID-19 virus. Now, what if I could give you this stock tip? What if I'd given it to you last July? Look at this company. This company went up 84% during the virus outbreak. Do you want to know what company this is? It's the stock price of Zoom. Now you're all muted. But I can guess what you're saying. Of course, Jack, tons of people working remotely. All you need is know a laptop and it's easy to use. Now, I want you to remember these 3 points for later. Tons of people, cheap equipment, easy tools. And then check out this next graph. This is a graph of not a company, but an industry. And it shows several years. Some of them are projecting into the future. When I show this to you, we're going to pop up an opinion poll. It's easy. You just pick yes or no, but you only have a few seconds to vote. So get your pointer ready. Yeah, baby, that's what I'm talking about. And look at the dollars. This graph is in millions. So last year was $2 trillion. This is what my kids call extra. Now, put your eyeballs back in your head and get ready to vote. All right, so I have some special insight into this industry. And I can tell you that this 2021 number of 6 trillion is conservative. And there are 2 reasons for this. One is advances in technology. The tool is good enough that non-technical people can use it to make money. And like Zoom, all you need is a low-end computer. You could, after this meeting, redeploy your idle staff, even your non-technical friends and family, to earn money doing in this industry right now today. And the reason number 2 why this is conservative is that the estimate was made before COVID. And like Zoom, it gets a big boost from remote workers. The total addressable market of this industry has exploded. The customers are literally buying 2- and 3-year-old technology because it's still good enough to meet the demand. Again, big market, cheap equipment, easy tools. Now here comes the last poll question from me. Seriously, put your finger on the pointer and vote fast. Yeah. Exactly. So I'm sure you want to know, what industry is this? Drum roll, please. But before, I want you to think about the emotion that you feel right now. And you are not alone. Everyone who learns about this wants to get involved in some way. So what industry is it? Oh, snap, it's cybercrime. Now, Pat might scold me for trickery in the sales process and straining the bonds of trust. But come on, we're talking about crime here, right? I mean, it's illegal, right? People are going to jail, right? Oh, not so fast. It's generally not a crime if your victim's in another country. If someone in another country tricks your employees to give them gift codes or a wire transfer, there's no US agency, and there's definitely no local agency that's going to pursue them. So let's just fix up that title. It's not the future of cybercrime. It's just the future of cyber. And so something else that's interesting in this industry, there is a robust marketplace supporting the cybercrime industry. In that marketplace, you could literally buy the tools, the email addresses, phone numbers, the templates, the English translations, the playbook with the latest scheme. The tools even come with technical support. So this means there are a lot of non-expert hackers looking for soft targets just like you. This is mature to the point that some of these are actual businesses like any other. Corporate office, quarterly targets, campaigns, bonuses, even an HR department. Before we say now what, how do we fix this? Let me just clarify that there are different types of cyber criminals. If a nation state wants to hack you, you will be hacked. Fortunately for you, those high skill resources are being focused on higher value targets. So my remarks to this group assume that your business is unlikely to be the subject of a targeted attack, a specifically targeted attack. So that means we're talking about low skill, greed motivated attackers who just want a quick payday. So how do you avoid that particular group? You just don't be the easiest target. Make them work a little. Let's see how we can do this. So to do it, you do 3 things that will help. Buy cyber insurance, lock your doors, and train your staff. This is not particularly new advice. It works for the physical protection of your business as well. So let's break it down some. Cyber insurance, think of it just like the new version of general liability insurance. Just buy it. You do not want to have to sort this out after a hack or a breach. It'll be too late then to set up your incident response plan. So do it now. You can't buy fire insurance on a building while it's on fire. Remember that you have 2 kinds of problems that you're trying to address with a cyber insurance. One is coping with the immediate attack and its economic impact. But the other one is the potential future lawsuit from your vendors, lawsuit from your customers, lawsuit from your employees if you have lost information that they view as valuable or sensitive. So you want to cover that as well. Your insurance should provide an attorney as your breach coach. So this means that you can use attorney-client privilege to reduce your exposure to future lawsuits by containing that information under that privilege. The incident response plan needs to have the phone number of the carrier, of the insurance carrier, the bank's fraud department, maybe the FBI, whatever is relevant to your particular business. And your insurance carrier should have a template, and your IT provider should also have a template or be able to help you find a specialist if you need it. All right, the second thing of lock your doors. Different names for it, but basically it's an alternative authentication, whether it's two-factor or multi-factor. It's the concept of name and a password plus something else. It's no longer optional in 2020. And fortunately, the tools have gotten a lot better than the old text codes. You can set up an app on your phone. Some are as simple as you sign in, your phone says, "Is that you?" You click yes, and you're done. If your online services do not offer 2FA, then consider dropping them. I'm serious. They got to catch up. And this should include your bank, your law firm, your CPA, your HR department, your financial system, and of course your email. So also do it for your personal Apple ID and everything else. The third step is training. Train the staff. They're easier to trick than a firewall. You've already trained them to be customer service oriented, and so that makes them vulnerable to being tricked by an upset customer. So you've got to have to fix that up a little bit. And you can practice the training of your employees. You can practice it by having your own IT department try to hack your own employees, like a white hat, right? To trick them with a phishing email campaign. And then you can measure their success as they learn. And just generally make sure they're suspicious of any tasty bait. TikTok, porn, fake Zoom meeting invitations, all that sort of thing are just designed to get people when they're not paying attention. They feel like they have to act fast. Employees should be suspicious of urgent email requests, apparently from the boss, to buy gift cards for an unhappy customer. And the way you can address this is create a culture that celebrates the people who double check with management for confirmation of unusual requests. Also, expect the attack to happen while you are away. Train your staff to use the plan without you, just in case it happens while you're on a plane to Hawaii or something and you're gone for 5 hours. Time is of the essence. They need to be able to act immediately. I don't mean everyone, but make sure you have enough people that knows how to handle that situation. So how do we get to do all this? Realize that this is a business problem. Approach it like a business problem, not just a technology problem. Insurance, et cetera, training, HR department. But your MSP, your IT provider, managed services provider, does play a critical role. First, find a firm you can trust. Just give them a little bit of time, get to know them, visit their office, and you're evaluating them. Do they outsource their help desk offshore? What are their key performance indicators? Make sure your IT provider is doing these same things. Ask to see their cyber insurance policy, their incident response plan. If they're not doing it for themselves, they're not going to do a good job for you. And then, after you've retained them, trust but verify. Have them give you a weekly report every week. It will imply that they have good automation. I don't care if you read it, but every now and then ask them to explain it to you. And then every 6 months or so, make them restore a file or an email that you removed a few days before. This will test those skills too, because that's the same basic process that would help you get out of certain types of hacks. I think owners should meet with IT for periodic strategic business reviews, budget forecasts. Ask them what the latest tech is that will increase your business resiliency, and then decide if you need it. Increasing your business resiliency helps not just for novel virus outbreaks, but just plain old-fashioned hurricanes. Okay, finally, every online tool is a potential door or window for the cyber criminals to crawl in. And you want to reduce that surface area of attack. Microsoft, Google, and Amazon, they're investing heavily in security. They have to. They can't afford not to. So you can leverage their budgets. If you have online email from Microsoft 365 or Google's G Suite, then use that. Don't have your own email server. They're going to have way more resources to protect it than your team ever will. Also, those systems come with so many tools in one place now. It's not just calendar and email anymore. It's everything, to-do lists, forms, video meetings, everything, all in one place, all in one security place. And your staff probably has multiple systems that do very similar things that have developed over the years. I suggest that you do an audit, you decide what you really need, you close as many accounts as you can. And then I had this other item that says prefer to buy from US companies. There's nothing magic about that. I know it's not a perfect solution, but think about it this way. At least it gives you someone to sue. All right, last one on this slide is the security assessment. To conduct that security assessment at least annually, you want to know where you stand. You're not looking for perfection. You just want to run faster than the other hiker. And your goal is to get a list of action items that you can prioritize based on your business. Think employee training. HR, this is really an HR topic. Put it into your employee onboarding and your refresh training. Employees are the easiest way to steal from you. So I have a link above also to a free self-assessment. Take one yourself just to review internally before taking it to a provider. You can do it. You can get a quick look at the basics. It should take about 20 minutes and then it'll increase your knowledge. If I had more time, I would explain that the US is moving towards cybersecurity all the way through the supply chain. This means that one day, maybe someday this year, your customer will be forced by their customer to conduct a supply chain risk assessment on your business. Think about that. It's not just who you're selling to, it's who they're selling to. And so protect your future revenue and start that process now. All right, well, thanks for attending. If you have any questions, please shoot an email over to me at the address on the screen. Now I'm going to turn the mic back over to Jim McCarthy to introduce our next speaker.
There in the technology world that's going on. Thanks for taking us through that. I'm sure a lot of people, much like myself, that run businesses don't really know what to do. They know that technology is important. They know it's a priority. They know it's growing fast. But it's one of those things where sometimes you don't know where to turn. So all that is very thoughtful explanation, Jack, and some great hints for everybody for what to be doing going forward. I'd like to introduce to you guys Pat McManamon. Pat is a Jedi master and ninja. I like to use the word ninja for somebody at the top of their profession. He's both of these things. He started Sandler Sales a long time ago. I worked with him 15 years ago. He trained all of our sales folks back in the day, and it went so well, we actually trained all of our operations folks, which may sound a little weird, but anybody that was touching the customer, we felt it was important to get this type of high-level training, and he is, in fact, a Jedi and a ninja. And Pat, you are now driving the boat. Try not to take it into the building. Grant, I think you got to unmute him. We may have hit our first technology glitch here.
All right, everybody good?
Now you got it, Pat.
All right. Well, good morning, everybody. Thank you for being here. I want to share with you some ideas and concepts to put into place during this time of, we'll call it uncharted territory. There's a, there's a constant need to change and look at our business and tweak and refine wherever possible. But in this world where we have, waters that have never been fished in, never been chartered before, it's everybody's in a little different situation. So I want to give you some tools that will help you to kind of break it down to figure out really where you can spend your time in order to maximize your efforts. So I'm going to break it down into what we'll call the continuous process improvement. It's something, frankly, that you could use throughout any time of business, but especially now when we're dealing with this COVID situation, and a lot of companies, a lot of industries don't know what the future holds. So when we look at the elements of the process improvement plan, or the continuous process improvement, it breaks into 4 different categories. It's structure, strategy, staff, and skills. And I'll put those in the proper order as we go through them. But strategy is the baseline, and we're going to talk about that. So I'm going to show you how they connect, and then I'm going to show you some action items that you can take to move through each of those, with the hope that you will then take at least 1 or 2 from each of the 4 S categories and put it into practice. So with that, let me move you to the next slide. All right. So as I mentioned, the 4 S's: strategy, structure, staff, and skills. Strategy is at the bottom. It's the base. That's where we need to start. We need to understand if strategy needs to change in today's environment. Oftentimes we'll see that people will make a strategy change, but then they don't look at how it impacts the rest of the organization. So we're going to talk about the interrelationship of all those. Once we have the strategy put in place, then we look at structure, understanding that in today's world, we may need to do things differently, work more effectively, work more efficiently. And so structure may need to change. And so I'll give you some action items that you can look at to do that. Follow that by looking at your staff, their skills and their skill gaps. And then finally, the specifics of each of the skills, what from a manager's perspective or an owner's perspective, what needs to be done in order to make sure that they're ready for today's environment. So with that, we'll look at strategy. But before we do that, I want to ask you a poll question. If you would, get your clickers ready and click on one and tell us where you stand relative to sales strategy as your organization. All right, so it looks like a fair balance between significant and some tweaking, and I'm sure that's going to be subject to what industry you're in and whether or not you've got to change product lines or product offerings. So let's look at some of the action items you can take specific to strategy. So again, strategy action items, if you would just look at these as I go through them and identify for yourself 1 or 2 things you're going to put into practice. So looking at the first thing, we all need to take time to identify our target clients and figure out what we're going to do in order to go after them. And this is not secluded to just the sales team or sales and sales management team. It could be the whole company, or it could be a department-wide exercise just to look at leveraging the things that you've got in place and what you need to take advantage of. So identifying your target clients, again, a company-wide exercise. Follow that by a process for getting in front of those target clients. And that could include things like a drip campaign. What are you doing to change your prospecting approach? We all know that it's getting more and more difficult to get through to people because we are working from home. And so calling their office line is not necessarily the right way. Leveraging referrals and also leveraging strategic partnerships will help you to do that. In that vein, make sure that you have a system for tracking your activity so that you know what's happening relative to what's most effective, what's having the best impact. And because it is difficult to get in front of new prospects because a number of people are just in complete lockdown or focus on just their own internal activities, recognize that your existing clients have a lot of your existing clients have a tremendous ability to help you grow because you have additional areas that you can sell to them. And it's a dual effort where you are looking for retention as well as looking for growth within them. So these last two relate to recognizing what your best efforts are in converting business and retaining business. And so establishing a regular plan with your clients to understand what their expectations are and how they're feeling about the service you're offering is a critical thing to do at this time. Because I want you to remember that your best clients are your competitors' top prospects. Okay? So moving on, let's do another poll related to structure. And so, thank you, Grant. Go ahead and complete that in 10 more seconds. And that's good. And the results are, some are making structural changes. Our market approach has not changed. So I'll just throw it out there. Is that because you haven't looked at it, or is it something that your business is moving in the right direction? It hasn't really been impacted, but either way, good luck. So doing the consideration piece, if those of you that are doing consideration of moving resources, that's an important thing because more and more companies are trying to do more with less. So realizing that you might need to bolster one department at the expense of another could help to keep some people on staff. All right, so looking at structure. These next two slides related to structure and staff are more related to, more directed at managers and owners. And so first one is, think about having a means for holding your people accountable. A lot of people like to avoid or try to avoid this thing called accountability because they're concerned that it creates friction between management and their people. But in reality, if the people are part of the process, they trust management, which is a key. If they trust their management team and they're part of the process of establishing what the criteria is, they're inclined to embrace accountability because they know the ultimate goal is to make them more successful. So also look at compensation. If you change your strategy, I've seen it time and time again where organizations will change their strategy but forget that their compensation plan still entices their people to do something different. And so you've got two divergent efforts going on. The organization is trying to move in one direction, and what's happening is the salespeople are working to just increase their commissions, which you can't blame them. So make sure that you look at the compensation plan to address that piece. Also have a measurement in place for management, so that there is a performance degree that everybody can understand. You all know the term KPIs, key performance indicators, things like that. And then also make sure that the team alignment is with the plan. And that again starts with the trust. And it also helps to make sure that the people understand what's in it for them related to this new plan. Next poll, let's talk about the staff themselves. Go ahead and pick one of those, and Grant, because there's only a couple choices, we're going to make it pretty quick, and that should do it. All right. Yeah, so a big increase in activity is going to be key. Some change in management structure. No clue. I like that. All right, well, those of you that said no clue, it's a good thing that you're on this call. That means you are thinking about it. So hopefully between the three panelists and Jim's expertise, you guys can get some insight. So moving on, let's look at the staff themselves. So first thing is recognizing that there is a lot of potential resources out there that you can look to benchmark your sales force. How do they measure up to your competitors? How do they measure up against all industry perspectives? And recognize that this may be a good time for them to do some self-reflection to figure out whether or not they're ready for the new approach and the new challenges that are facing us all. The next, from a management perspective, is looking at your people from a standpoint of understanding where their skill gaps are, helping them understand where their skill gaps are, and providing the tools and resources for them in order to be successful. And also to make sure that you're leveraging their strengths, especially as you think about the slide earlier, I talked about structure. If you start moving people around, understanding what strengths they have so that you can capitalize on that. Next, you need to determine who will fit in the new direction. There's some people, unfortunately, that may not make it in this new landscape because they are set in their ways and are not willing to move forward or not change. And so you may need to make some tough decisions. And then finally, make sure that you're hiring appropriately. Make sure that you've got a defined interview process, onboarding process, and selection process, because inefficient hires is probably one of the costliest items that happens to management. And then finally, understand the management role with the team is broken down into 4 different categories: supervise, train, coach, and mentor. And in today's marketplace, today's environment, coaching is key. And a lot of that comes from where your trust is based. And if you're able to coach and be a resource for your people, they will stick with you. And that's what helps develop the culture. One last poll, and then we'll move through skills quickly, and I'll turn it back to Jim. So go ahead and answer this poll, and we'll go forward. Just take 10 seconds if you would. All right, prospecting, qualifying, and all of the above are key things. And I'm glad nobody picked the last one, so that's a good thing. All right, let's look at some of the skills that can be considered relative to what needs to improve. First is understanding the importance of high impact questions. Work with your team or as an individual, identify what are the high impact questions that will really engage your prospects. Have those chronicled and available for everybody on the team to use as a resource. Understanding the importance of qualifying. Qualifying is a key thing to recognize that if you're doing more with less, spending time with prospects that are not willing and able to take an action and make a decision is not good use of anybody's time. Prospecting, there's a new sheriff in town, if you will. There's a new way to approach things, and recognizing that leveraging technology might be one of the things that needs to happen, but prospecting is not necessarily, there's probably a good example is you're not even probably going to be allowed to walk into businesses for the most part anymore, any of those that you used to do walk-in cold calling. So think about how you're going to go to market. If it's first step is via email, then make sure that you draft some professional email templates to open up the conversations and leverage some of the social media things like LinkedIn. Understanding that closing is about getting decisions, getting your prospects to make decisions. Professional salespeople are proficient at facilitating decisions, and closing is closing the sale or closing the file. Finally, make sure that you're not doing free consulting where you're not leading with features and benefits. Many people in this world of having to sell from a GoToMeeting platform or a Zoom platform are thinking that they need to lead with features and benefits in order to get their people interested. But we still need to make sure that there's qualifying questions in order to tee them up and pique their interest. So I encourage you to avoid that free consulting piece, because people will often just take the features and benefits and not make a change. And then lastly, make sure that you're calling on decision makers, people that are willing and able to make a decision, and that will help drive efficiency. Decision makers call on decision makers. So if you yourself are not a good decision maker, you need to work on that trait from your own perspective. And so with that, Jim, I will turn it back over to you.
Thanks, Pat. Some very insightful stuff there as well. I mentioned before, I've worked with Pat in the past. It's pretty enlightening stuff. For those of you looking to make some changes in your sales area, obviously customers are key. Very important, we pay a lot of attention to them at this point. Check it out. So again, Pat, thank you. I want to introduce our last speaker today, Alex Jenkins. I will leave it up to you to figure out which one of the famous 5 he is from Animal House. I've seen multiple versions of him, so I will remain quiet on that. But Alex is a great combination of personality and intelligence, extremely bright, and you see that's why I've got the Goodwill Hunting photo there. I was very impressed with him. The very first time I met him, he asked a question that almost blew my head off in a seminar, and I knew I had to get to know the guy and find out what the heck he was up to. So he's going to talk to us today, like I said, God knows what, but I know it'll be enlightening for you. He comes at things from different angles, and I would encourage you to think about questions for him and our other panelists. I can already see our Q&A bucket filling up. So please get those in. We'll wrap with Alex, and then we'll get into Q&A, and we'll try to get you guys back out to the rest of your day. So Alex, you are on.
Thanks, Jim. It's clear to me you've probably already been drinking this morning, or one of my colleagues maybe slipped you a $100 bill for that type of praise. But regardless of which it was, I'm grateful for the commendation and the good words. So, guys, today, COVID is kind of in our wake at this point, at least in the Northeast Florida region, and we're seeing executives pivot from the PPP rush of getting the money and then figuring out, can we keep the money, and now getting into the nitty-gritty of their P&L. And so there's a lot of areas. We've had a lot of dialogue with a lot of executives, a lot of clients, a lot of prospects. Where are they focusing their energy? And there's 4 key areas within the P&L, and then holistically their tax strategy is something that they're taking a hard look at. for purposes of my contributions to today, I'm just going to be focusing on one key area, which is the employee benefits, specifically 401k or pension obligations that a firm has cost obligations to. So next slide, please, Grant. My goals for today, as we kind of walk through this particular topic, is first, I want to shift the mindset of all the entrepreneurs, all the executives on this call. I want to kind of get everybody out of the commodity mindset that permeates the industry and get you away from thinking about your company retirement plan as a necessary evil and shift your thinking to looking at the qualified plan as a tax tool, something that you can use to dramatically increase your own net worth. So as we wander down this road together, I'm going to talk about how to pare back your plan in 2020. So just some short-term instant gratification type cost containment elements. But then most importantly, I want to focus on what's important for 2021 and beyond. A lot of conversations were not happening that should have been pre-COVID. And so hopefully I'm able to showcase some of that to you today. And then we'll kind of wrap it with a very dense, it's going to be kind of small. You may have to lean in, but a presentation of kind of an example that shores up some of the concepts that I'm going to touch on. Next slide. So the reality, you guys could pick any CPAs of your choosing, grab 10 from all four corners of the United States. They are all going to objectively tell you that the qualified retirement plan in the firm is one of the single largest tax deductions available to ownership. Another reality is that that very same qualified plan can be a tool used to create tax efficient extractions of wealth from the firm into the pockets, so to speak, of that entrepreneur. Sadly, another reality that doesn't quite jive with these two considerations is that pre-COVID, very few people were having that conversation. And I say that with certainty because we know 22 years in business that there are very few people out there having those types of conversations. The marketplace in which qualified plans were being bought and sold was very commoditized. Both supplier and purchaser were looking through the lens of commodity. Again, that sort of necessary evil consideration is what was driving most of the energy in vetting a plan and operating a plan. Again, very few people were talking about how the qualified plan in the firm can be utilized and weaponized, that's the word we choose to use, to create some tax efficiency. So I make these assertions. How do we know? Well, again, just look at the construct of the marketplace. Considerably important to note is that generally the sales mechanism for driving a plan into the hands of a business owner was a non-technical salesperson representing either an insurance or a financial brokerage. But those salespeople are selling off of a script. We call them templated or checkbox plans. Most of you who sponsor a plan on this call likely sat down with somebody and they showed you 2 or 3 pieces of paper and said, what type of plan do you want? Here's this type of plan, here's that type of plan. Check a box here for that feature, check a box there for that feature. The unfortunate reality of that is that if they're not bringing into the talk track or the considerations in the building of your plan, the company census, right? The demographics of your personnel, their age, their dates of hire, their salaries, and they're not leveraging features of the Internal Revenue Code, then what you end up with is a very pared down, very narrow qualified retirement plan. And so when that occurs, that is where the forfeiture of tax efficiency can actually happen. So we're going to dive in just a moment on some options. We're going to kind of come back to this conversation of tax efficiency. We're going to dive in and show you some options for how to pare back your expense in 2020 on your plan. But first, Grant, next slide, and I believe we have a poll for everybody. So guys, don't spend too much time on this. If you think you know, these are some of the more general styles of plans available. Just go ahead and click what you think you have, and then we can go from there. Probably sufficient on time there, Grant. And let's see the results. All right. So we have some 3% across the board, some safe harbor match. Some people, a quarter of the group, I honestly don't know. That's okay. Hopefully by the end of this presentation, you'll at least know what questions to be asking and who to go speak to. So let's advance to the next slide. So guys, I told you we would walk through what's important about the market going forward, where some of the deficiencies were in the market pre-COVID and what to think about post-COVID. But let's focus on right now for just a moment. What can you be doing to immediately potentially mitigate cost within your company retirement plans? Well, there's basically two actions that can be taken right now and some of the more general styles of plans. I characterize one of them as kind of a mild action, and then I characterize the other as a very strong action. So the first mild action is every plan can be set up with an eligibility constraint such that those personnel that you hire must have to wait for a prescribed amount of time before they can participate in your company plan and reap the reward of your company contributions. The extreme or the far end of what's available for that waiting period is 1 year and 1,000 hours of service. So if you have an eligibility requirement that is less than that, meaning if your people can show up for work on day one and participate in your plan, or if it only takes a month for them to wait, or if they're able to enter quarterly, or maybe it's biannual. If you have anything less than a 1 year eligibility requirement, you do have the ability to amend your plan to increase it out to that 1 year of eligibility. And what that's going to do is prevent people who are otherwise potentially about to become eligible for your plan to have to sit on the sidelines for a little longer. Now, anyone who has satisfied the eligibility requirement for the current year is going to be grandfathered in according to the old eligibility requirement, but anybody that hasn't yet can be held out. And so that could serve in a firm of any consequence in terms of personnel to save you guys some money. I get the sort of emotional complexities, the cultural considerations here as you're looking at hiring, retaining, and really trying to shore up company culture with your personnel, but this is an area where you guys can immediately kind of narrow the bucket of people that have to be participating. So if you were to do this, you would have to draft an amendment and submit that notice to your employees, giving them warning. The next action, this is the more strong action. This is for that firm that says, Lord, I don't know what's coming down the pipe. We've seen a major dip in revenue, bottom line suffering. We've got to find dollars and pennies anywhere that we can find them. With any of the general types of 401k plans that you might offer in your firm, you do have the ability to draft an amendment which suspends your obligations to contribute into the plan on the behalf of your employees, even if you had a really robust match leading up to this. Now, certain types of plans are going to necessitate, truly require a 30-day notice to your employees. So similar to how that eligibility consideration worked, anybody up through that 30-day notice that was getting a match is going to still be entitled to that. But once the 30-day notice has run its course, you can now shut off what your obligations were into the plan for the duration of the year. A key consideration here, some of you, I saw you had the 3% safe harbor non-elective contribution. Some of you have that safe harbor match. Generally, that's done in order to afford the highly compensated or the key employees the opportunity to max themselves out and not get refunds at the end of the year. If you guys are going to contemplate drafting an amendment like the one I just told you you could, and stopping those contributions to your employees, you do want to contemplate your key employees and highly compensated employees maybe stopping deferring or risking refunds at the end of the year based on how the various testing that governs these plans comes out. So compliance testing has bearing on that. So I characterize the result of this as future employee costs can be eliminated in the current year, depending on where you are and which of these two options you choose to sort of consider doing. So the underlying consideration, and we're going to pivot once we get through the next two slides, is can you guys say with any level of certainty that you received consultation deep in the weeds that showed you that these plans were right for you to begin with? And piggybacking that question, do you know on the back end of COVID, in times of uncertainty in both personnel requirements, payroll, revenue, margin, most importantly, do you know for certain that these plans are going to meet the needs of your organization going forward? It's a rhetorical question. We'll touch on why that's so important as we get through this. Grant, we can move forward. Profit sharing plans. 401ks offer you the ability to tack on a profit sharing mechanism to your plan. You also have the ability to sponsor just a true profit sharing only plan within your firm. there is a way to write a profit sharing plan in which each employee is written into their own classification. We call that a cross-tested plan. What that basically enables is different people receiving different benefits legally within the plan. And so if you have a profit sharing plan in which each of your employees is in their own classification, and if it's not also a safe harbor plan that it's tacked on against, you can handpick who is going to get a contribution this year and who is not. And of those you choose who get a contribution, again, you could give Johnny $1 and you can give Jimmy $10. You get to kind of pick and choose in that way. The result here is, in times of mega uncertainty where everybody's kind of going home and staying up at night wondering what's going to happen, you're going to be able to benefit the key people that are integral to your firm survival and success post-COVID. And additionally, you could actually use this as a tool to bonus folks, and it wouldn't be subject to your conventional payroll taxes. It is, of course, going to be subject to income tax. So considerations here, why, if you have a profit sharing plan and each employee is not in their own classification, just a curiosity, why? And then again, is this plan style appropriate for my firm going forward? Did we ever truly look at the tax implications of this in the beginning, such that we knew that it was the right plan up front? Go to the next slide, please. Finally, those with a cash balance pension plan or any form of defined benefit pension plans, I saw it was about 10% of y'all sponsoring these plans. These necessitate an actual balance at the end of the plan or at the retirement distribution period for that employee. So each year the firm is accruing a liability for money going into the pot that's going to pay that defined benefit to the employee at retirement. The action that we are telling all of our clients, and we see and deal with quite a lot of the cash balance pension plans in particular, freeze the plan. There's no harm in freezing the plan. You have the ability to unfreeze the plan if and when you so choose, if your revenue stabilize. Similarly, you can terminate the plan altogether. But with the accrual of the liability in a pension plan, the best course of action right now in all of this uncertainty is to freeze the plan. Depending on the number of participants in your plan, that will govern what type of notice you have to give your employees. So if it's less than 100 participants, you're going to give them 15 days notice. That's required. If it's greater than 100 employees in your plan, then you will need to give them 45 days notice. Guys, the key here is that these pension plans necessitate a financial obligation from the firm. So freezing it is the best course of action. Even a frozen plan, this is a caveat, can incur a liability despite the fact that the plan has been frozen because of balances and minimums that are needing to be kept in the trust account for the plan. So just know that with all plan styles, you guys do have the opportunity to attain some immediate gratification and cost containment for the current plan year. But okay, Alex, we've contained some costs for 2020. You're talking about tax efficiency. Perhaps this is a dialogue that I'm unfamiliar with. Tell me a little bit more about that. Grant, if you could cycle forward. We are recommending to everyone that we talk to, and for our existing clients, this is just a standard function of yearly what we do mid-year every year. We're looking at the plan and saying, does this still meet both the cultural objectives, the demographical realities, and the revenue aptitudes of our firm? Does this plan style work? But now more than ever, we're analyzing where can we pare the plan down while still preferentially ensuring that the owners are able to save money into the plan. But we are telling everybody that will listen, you need to look at your plan this year. You need to actually have the census information of your plan be the North Star in terms of the design of your plan. Without that census information, the plan style can never be actualized as truly beneficial to the firm if there's an alternative that is better. And so, you know, the opportunity to an owner, when we're talking about tax efficiency, we're talking about top line falls to bottom line. Bottom line now is taken as distribution income. Well, that distribution income is now taxed at effective income. Okay. Conversely, what if we took those monies before they hit the bottom line and allocated them into a plan? Is there more monies going into the account of the owners such that less money is going to Uncle Sam and we now have achieved some level of tax efficiency? That is the lens through which everyone should be attacking the design of the retirement plan that they're implementing into their firm. So ERISA, it's the big elephant in the room, right? And most folks believe that they've implemented a safe harbor style plan because of ERISA. You know, my highly comps or my keys can't defer a lot if I don't have some safe harbor provisions because of ERISA. That's more or less very true. But the reality is these pared down menus, these sort of check a box style generic plan templates don't leverage what can be leveraged that's written into the Internal Revenue Code. There's a lot that governs how these plans can be designed. And unfortunately, it's kind of a churn and burn industry. How quickly can you sell a plan? Well, when you want to sell it really quickly, what do? You narrow the menu. And so a custom plan design built around your demographics is going to ensure that the plan is meeting your firm's unique needs. Next slide, please. So this is an interesting one. Guys, if you don't know the answer, that is okay. Probably 85% of you won't. But do you know what percentage of every dollar that goes into your plan is allocated towards the owners and key executives versus the rank and file employees? If you just want to hazard a guess, that's fine. All right, that should be sufficient in time. I love the honesty and the last answer. Okay, so it looks like about 20% of you have got some efficiency occurring. Everybody else is kind of scattered, so that's good. Thank you, Grant. We'll go to the next slide, please. A tale of three plans. Guys, tying this all back to the design of a plan and looking at census demographic information. What I have in front of you here is a real firm, 4 owners in their late 40s and early 50s, a rank and file employee contingency of about 85 heads, varying from very low wage, low skill up to some decent secretarial administrative type employees making in the neighborhoods of $60,000, $65,000. So frankly, a very nice cross section of like the average firm. And what I seek to demonstrate here is the consultative element in designing a qualified plan is crucial for tax efficiency. I think I've beaten that horse to death over the course of this, very brief presentation, hopefully very brief. But there's more than one way to skin each cat. And so in a firm with owners of disparate ages, there's different desires, right? Personal cash flow at the house means maybe I don't want to defer the full amount that I can. Maybe I do. I'm getting older. But the key is if you don't know the options and you can't actually ascribe a value to the type of plan at the employee level, of course, then you really are running blind about what that plan is truly going to cost you, what some sort of laws of averages are within the performance of that plan. And so true, meaningful, tax-informed decisions cannot be made. So if you look, I don't want to blow everybody's eyes into the back of their head with all of these numbers, orienting you to what you're looking at. The first column is the current plan. I've, of course, removed the names for anonymity's sake, but under the current plan, the owners were achieving between $18,000 and $29,000 worth of deferral opportunity for themselves at a cost of about $48,000 for the employees. Hopefully everybody can see total owners, total employees, right? 96,000 versus 48,000. In the margin of the column next to it is 66% and 34%. What we're showcasing there is 66 cents on the dollar in this plan is going to the owners, 34 cents on the dollar is going to the employees. And for brevity's sake, as you wander towards the other far right-hand margins, plan option 1, plan option 2, plan option 3, what you're going to see is a very large increase in deferral opportunity for owners. And what occurs is actually a staggered increase in employee-related costs. So you start to see a little bit more efficiency in dollars spent within the plan. Unfortunately, plan option 3, the margins were cut out, but I know that just from looking at it, the plan was near 80-20 in terms of efficiency. Here's the big consideration, right? Each owner, different age, each owner has different cash flow realities at home. With different options, looking through the lens of tax, these guys now have the ability to say, you know what, I can't afford a $160,000 annual deferral. I need that distribution income to finance my lifestyle. Or maybe I can do it. But the key is between plan option 2 and plan option 3, these owners are now in the driver's seat to look at a 5-figure deferral opportunity and a 6-figure deferral opportunity. And so then they can dialogue internally amongst themselves about which option makes sense. Now, drop your eyes all the way to the bottom of the screen. Last thing that I'm going to show you. Far left-hand bottom corner, it says Advantage to Plan. This is the tax efficiency of what has just been implemented, i.e., if that money was instead taken as a distribution instead of being put into the plan, how much of my money am I sheltering from Uncle Sam? And as you can see, plan option 1, not that sexy, only moderately more efficient. Granted, we're getting a little bit more money into their hands. Plan option 2, okay, we're saving a little bit in tax, again, approximately $5,000, $4,000 per partner, not that great. You start looking at plan option 3, and I think eyebrows are probably raising. Talking about saving $25,000 worth of your money from taxation. Now it's getting into the market. It's growing tax-free for the time being. And most importantly, it's beyond the risk of creditors. So if you do end up getting sued because you didn't hire someone wonderful like Jack to protect all of the tech infrastructure within your firm, then they're coming after those assets. Whereas if they were in a plan, they would be on the risk of creditors. So guys, the message here is the qualified plan is a tool. It's not a necessary evil. If you're not using it as a tool, definitely recommend finding a consultative team of professionals to walk you through scenarios like this, where a true analysis, both in cost and tax efficiency, can be presented to you. So with that, I appreciate everybody's time. Jim, especially appreciate you having me on. Great job, Pat. Great job, Jack. And like Jack, if you need to reach me, my email is alex@nesteggs401k.com. Back to you, Jim.
Thanks, Alex. He doesn't disappoint, as I had mentioned before. And I got to say, another section here where I believe folks are thinking about it, maybe not thinking about it, but it's time to pay attention to that. He listened to the advice there in the vehicles of what you could do to help get through finding new ways to create more value for your money, really, and some savings. So, Alex, thank you. And thank you, all of you guys. And thanks to all of the attendees out there for the first hour here. And we only have 3 more hours to go. So just hang in there. Actually, in all seriousness, we're at the Q&A portion of the program, and the bucket has filled up. We recognize you guys all have busy lives, so we're going to try to rip through these as many as we can. We'll do a hard stop at 12:15 and let everybody get back to their lives. So we'll start off here with the Q&A. Let's see what we got. So the first one here, we've lost a fair amount of customers during COVID. We're searching for ways to prevent this. Any quick suggestions? So I know it's probably good for Pat. Pat, you touched on some things in your part of the presentation. Everybody's always looking for the sort of magic powder or a quick fix. Maybe one thing for our audience, Pat, that they could start focusing on right now that could have the quickest impact.
And not knowing the specific industry, it's hard to answer directly, but I will give the thought of having a mindset of helping your customer's customer. So look at the business from the standpoint of how can your service, how can your product help your customer's customer? And if that doesn't resonate with you, then look at it from meeting with your customer to really be empathetic about where they are and asking them how you can help them through this. You'll be surprised, I think, by having a very healthy conversation and very open and transparent that you may actually have new product lines come out because of that conversation and that feedback.
Thanks, Pat. Let's get to another one here. Question for Alex. I never had anyone sit down and analyze our demographics when we put our plan together. What would you suggest we do?
So, not to beat the dead horse, but that's what needs to be done. So partner with a professional. So generally the mechanism for sale in the market it's broker driven, and brokers are selling off of a template given to them by the record keeper administrator outfits that process payrolls and allow mutual funds and all of that. So partner with a professional that has the third-party administrator designation. So there are 3 service providers that collaborate for the production and service of a retirement plan. One is called a third-party administrator. One is called a record keeper. One is called a registered investment advisor. The TPA is the one that can do all of this analysis and do these projections and characterize costs in and out of the plan as it pertains to tax efficiency. unfortunately, the TPA is not the tip of the spear. He's not the one that's selling the plan. 99 out of 100 plans are being sold by these brokers. And that's the reason for the pared down menu, right? The broker's not the one that is the third party administrator with all the technical know-how. And it's a cumbersome process. It's going to take a TPA anywhere from 6 to 12 hours on pension plans, maybe as many as 20 hours to analyze a firm's demographics and come up with a plan that can truly work and meet the objectives. So definitely find a entity that has that consultative element and that is a third party administrator capable of doing those types of designs.
Nice. This one is for Pat, comes from Justin Jones. How do you treat the line? How do you tread the line in selling / prospecting with most businesses in my industry, particularly taking a hit and not doing any business as they are based on having large gatherings?
Yeah, I think the answer is similar to the prior one in that getting to know your customer and what strategy they're looking to do going forward. If their business has been impacted and may be impacted forever, they're probably looking at what other product or service they can bring to light. And if you can help them in that process or even be part of that process, you'll be an integral part of their business as they move forward.
I like that concept. There's a question for Jack. Can I use COVID as an excuse to cut redundant or overlapping IT services? That's just a two-parter for you, Jack. And the second part is it safer to put most of our services with one provider?
That's an interesting question. So if your employees or you have some favorite set of services, this might be an excuse to say, look, we got to drop these 3 things and we're going to use Google's G Suite tools or Microsoft 365. I think it's a great time to use that as a chance to streamline some of your cost on it, even if it's not high. Cut as many as you can. And I think it is safe to double down on products from the big name brands, right? So if you're Amazon Web Services, yes, it's going to be safe. It's going to be safer than you can make it, right? And same with Microsoft 365 and G Suite. I mean, I'm not reselling these tools, but there's just no way you're going to compete against the budgets that these guys have. And they have so many tools inside their services that it's going to squish out some of those smaller players. So yeah, I would say go for it and, cut pretty hard and use it as an excuse to streamline your processes, right? Every time someone switches from one tool to a different tool, they lose a little bit of efficiency. Put them all in one system. Some people will bitch, blame it on COVID, and you'll be happy next year when it's more efficient.
Great. Thank you, Jack. We were about to sell our company, but with the downturn, we were unsure if we should. Any thoughts on how to move forward? I will actually answer that one. We are in the market talking to buyers and sellers every day, and this COVID has had an impact on everybody. There's a few, I would say, industries out there that have actually done better, but for the most part, folks have had a decrease. So it is interesting. It kind of depends upon a lot of different things. So I don't have a fast answer for that without really knowing the dynamics around it. But we are really trying to listen to the business owners that have this as a consideration. We're in constant discussions with buyers all over the world about what they're seeing and feeling. And some of the buyers are ready. We're picking up pencils on deals that we had going pre-COVID, which is nice to see some action again, deals happening. But there are plenty of buyers out there that are focused on more operational issues because of COVID, and they may take a little while longer to get back in the game. So I think the best thing you could do is really put good thought into it and get advice from folks that know what they're doing around that and have their finger on the pulse of the market to be able to give you some good feedback on which way you should go. I'll get 1 or 2 more in here. Let's see here. Sorry, I'm sifting through. This is a hair cumbersome. Some of these are overlapping. We are looking at all expenses during this crisis and hadn't thought about benefits HR stuff. Seems like a cumbersome and time-consuming process that probably won't change much on our P&L. So, Alex, I'll give you that. I've been through that myself with my business in the past. I think that's an interesting perspective. What do you say?
I think, you know, from my particular chair, which is specifically 401k qualified plans, the amount of effort is close to not. Drafting an amendment to cancel or suspend any sort of match obligation should only necessitate, you know, an email request to your provider, and then, you know, maybe particular providers charge for a la carte services like that. But then it's just a matter of HR getting out an email to the employees, and then any sort of fallout that may occur from that kind of culturally having to be mitigated. But the suspension of match requirements or the lengthening of eligibility requirements is pretty, that's why I was characterizing it as instant gratification. It's pretty easy. Now, the sort of duality there is, how big is your firm? If you've got 5 employees, sure, then maybe it's not consequential in terms of saving dollars. If you have some mass in your rank and file, then it could absolutely save you money and instantly for really the next now close to, I guess, 5 or so months. But again, I can't advise you on the unique personnel and cultural considerations within your firm. I don't know whether everybody would take the lump and just keep fighting, or whether there would be a mutiny amongst the sailors. So that's a decision you guys would have to make. But as far as complexity or work, no, that's very low effort, very, very easy. And again, I'd encourage you to partner with a professional that can not only suspend that for you now, but then advise you on the best strategy for 2021.
Perfect. So I think with that, I'm going to cut the Q&A. We do have some extras here. I'll sift through them. If there's no redundancy, then we will send those out afterwards to everybody, along with a recording and a copy of the deck. And I'll leave you with this. Again, just a thank you to Jack and Alex and Pat for being on today and for the efforts they put into this and the work that goes into this. And more importantly, thank you to you guys for joining, all of you attendees. Really appreciate you taking the time out of your busy day and busy life to be with us today. We're hoping that we brought you some good insight. You got a few nuggets out of this thing, and you can go into Memorial Day weekend, get some rest, relaxation, have a little fun, and come back ready to make some shit happen next week and bring us out of this this COVID time. I think we're well on our way, and thanks again for being here today, guys. That's it. Enjoy your weekend. God bless America. This one's over. We'll see you next time on part 3. Thank you.